you're global, to say the least. At this point, let's just start with the United States. Equal weight, but within that, you have some overweight and underweight groups. And then we'll move on. But could you go into that quickly for us?
Yeah, sure. Look, we have been overweight in the U.S. in IT, in communication services, and in healthcare. One of the criteria that we're looking at, however, is how close are we to a juncture point in the market where it's going to be a good time to start rotating in more high-quality cyclicals, and that's what we've started doing. So we've started moving into some financials, higher quality financials, a little bit more into some of the industrials, and that's what we are at the moment. I think what we're seeing in the market in the U.S. is that this has really been a bear market rally, where investors have piled into stocks that gave them the comfort of other resilient earnings or earnings that actually benefited from COVID. We are closer to the end of that. We're closer to the end of that bridge, as Jim was defining it, than we are at the beginning. And this also means that at some point you will have to have the rotation. We still keep some powder dry, and we also are really limiting ourselves to the higher quality cyclicals where we see some structural stories. We've seen the bank results, but we're definitely at that point where we need to start following the signs of a recovery.
It's semantics, but I assume you're talking it's not a secular bull. Obviously, it's a cyclical bull because we've regained 42% or something. So just in terms of semantics, but you don't think it's going to continue into a secular bull. I think part of that has to do with, you think at best it's a U-shaped recovery. Is that, and maybe even a W, although you think the chances are not great for that. Is that in the United States or that's global?
So that's going to be global, and some regions are going to do better than others. And clearly right now, that's the reason for our call on North Asia, since actually last quarter where we said North Asia, China, Taiwan, Korea actually coming out better than other regions from COVID, and their economies are starting out better. And so that's actually where we have an overweight. But the key here is not, we don't expect the market, even in the US, to collapse. We don't think that there's going to be a W-shaped recovery. It's probably going to be a U-shaped recovery. The key is, however, when you're starting to see an improvement in the macro data, then you will most likely have a rotation. So, you know, some of the reasons underpinning the mega large cap outperformance are clear. If you look at e-commerce penetration in the US, it went from 5% to 11% in the 10 years to March 2020, and then it went up to 27% in just 2 months. So clearly something is underpinning those earnings, that there's no reason for some of those mega caps to collapse. But we do see the potential for rotation, also because the companies that would benefit from that improvement in macro, also the companies and the regions that have been, if you want, left behind and where valuations are more undemanding. So I'm talking about North Asia, I'm talking about Europe, I'm talking about some industrial names, some specialty material names. Those are the areas that we're liking.